All right, tomorrow, the payrolls report will be released in the morning. Economists and investors will be watching closely for any sign that jobs are coming back after more than 2 years of losses. Joining us now to preview that report is Neal Soss, chief economist at Credit Suisse. And Neal, we talk about this jobs report. We've really been talking about it all week. Everyone is anticipating it. But you say that's not what is affecting these markets. Jobs are not moving these markets right now.
Oh, I think today's market is not a reflection of people having a concern about how far away from an unchanged figure we report tomorrow. The range of estimates by professionals who worry about monthly job counts is quite narrow, and it's quite closely distributed around unchanged. That's better than where we were before. It's not great, and I don't think anything about that's a particular surprise. Right, I think these markets are reflecting sovereign sustainability questions. They happen to be focused at the moment in Europe, but we've got our own sovereign sustainability issues right here in the United States.
All right, I want to talk more with you, Neal, about jobs, but let's talk about that sovereign risk, not only outside the U.S., but you say inside the United States. I mean, what are you expecting on this front? You know, we focus on what's going on in Greece, but, I mean, what are you worried about specifically here in the United States when it comes to sovereign risk?
Well, the states of the United States are, in a formal sense, very much like the countries of Europe. They are entities which do not have an independent monetary possibility. They can't adjust exchange rates or their short-term interest rates or their monetary policies when they get hit with a shock. So when something happens to those economies, the first thing that goes is the fiscal situation, which tries to buffer things. That's all very appropriate. But if the shock is so big that it overwhelms that fiscal adjustment mechanism, then the budget deficits themselves become a problem. And we have plenty of states and cities in the United States which look very much like that. Illinois can't have separate money from Texas, just as Greece can't have separate money from Germany. It's formally a very similar situation. And we have plenty of states in the U.S. whose budgets are quite seriously out of whack.
So what does this mean when it comes to your long-term outlook? I mean, these are problems that aren't going to be changed anytime soon, right?
That's right.
And so are we headed down? Are you bearish for the year? Are you bearish for the next 2 or 3, 4 years?
I don't think it's a matter of being bearish. To assert and observe that there are challenging circumstances ahead doesn't mean that markets are overpriced at the moment. They may rather be in a kind of trading range with a certain amount of violence attached. So I don't think you have to be bearish, but I do think that we have to recognize that these fiscal sustainability issues reflect the fact that all over the first world, we have made promises to ourselves through our governments, and it's not clear that we've got the GDP to fulfill those promises. We need serious political leadership to deal with that.
So, Neal, how do you expect this to play out then in terms of the state of the states? I mean, we're just coming off a very, very rough year, obviously, for the economy. I mean, is it another year like that that you anticipate coming?
Oh, I don't think the economy will do as poorly. In fact, we're looking for a recovery. In fact, we're somewhat at the optimistic end of the range of forecasts in terms of GDP. But being at the optimistic end of the range at the moment means you're still forecasting half the size recovery that business cycle history would have led you to think about. And part of the rationale for that is precisely that the state and local governments are going to themselves have to be imposing fiscal restraint. Not because they want to, not because they're mean-spirited, but because they have no choice. They have to raise taxes and or cut spending. Both of those, or either one of those strategies, is part of the restraint on the U.S. recovery, and I think that we have to acknowledge that as part of the backdrop.
You know, we saw the fiscal 2011 budget just a few days ago. Do you think we're doing enough there on the federal level?
Oh, I don't think there's very much about that budget that makes you reassured on the long-run fiscal sustainability issues of the country taken as a whole. I think in the short run, the creditors of the United States are willing to continue to finance us. That's very good news for now. And I think there's very little private credit being created on a net basis. Housing is not at a high level. Car sales are not at a high level. Business investment can be internally financed. So the claims on the credit resources of the economy are not that great at the moment. So you can run a big budget deficit now. But down the road, you really want to get that under control. And the problem with what I just said is the temptation is to say, if I don't have to start my diet this afternoon, I'll just have another cupcake and worry about it starting tomorrow. And nobody ever got skinny doing it that way.
That's a great point. Neal, I want to go back to jobs. And you, from what I understand, you point out that we need 2.5%, I think, GDP growth for a more robust, to get really job growth, a more robust job market. We're going to get that in your view?
Yeah, we're expecting that the unemployment rate will tick up a bit more now. Part of that is actually constructive. Part of it will reflect the fact that jobs are beginning to bottom out. The labor market's bottoming out. People are starting, I think, to be a bit more optimistic about their prospects for getting a job, so they come back into the labor force.
Right.
But if they don't get a job literally immediately, then that gives you a little upward pressure on the unemployment rate. We're looking for a few more months of that, maybe get the unemployment rate at, let's say, a 10.5% peak level. But by the end of this year, we're looking for something that's closer to 9.5%, reflecting the GDP growth of the intervening quarters. Now,
that seems in that case pretty optimistic. What are you looking for as far as GDP growth? Because we hear from a lot of economists that you need at least 3% per quarter to grow jobs.
Yeah, we're looking for 3.5% for the year. More of it in the first half, a little less in the second half. And I was about to say that, to say that we're going to get unemployment down to 9.5% is in some ways an achievement. It's better than where we are at the moment, for example. But that's still a pretty dreadful level. That's a circumstance where nearly 1 out of 10 people is still out of work. Nearly every household in America is going to either know somebody out of work or be concerned about the assurance of their own employment situation.
Neal, we got about 30
seconds. Work to do.
We got, no doubt. We've got about 30 seconds left here. So help me. In 6 to 8 months here, where are we going to be in terms of the economy? And I have to ask you to be kind of quick here.
We expect that the economy will be growing. We expect that jobs will be growing. We expect that growth will be at decent enough rates, but the levels of activity will still be very low relative to previous peak levels.
All right. Good to know and good to break it down with you. Neal, thank you so much. Neal Soss of Credit Suisse.